the things that might impact you coming up here in the future, some of the issues that you might want to deal with or be aware of, some of the concerns that you might have, or some of the issues that you might be looking at. And it again, it's not a financial planning show, but of course, it can help you, of course, with some financial planning. But it's really an economics type discussion about some of the things that are happening, and what outcomes we might see from some of the things that are taking place. So, my name is Mark Breckbill. I'm a CPA and ex-banker, and have been in business here in Stuart for since 1986. So it's been a while. And have had an opportunity when I was in the banking industry to deal with some of the economics of some of these issues over the time and over the history of what's happened, economically. And so it's been useful for me. So I felt like maybe we could talk about some of these issues. You can call in at 220-9788, 220-WSTU. That's area code 772-220-9788. If you have a comment or a question. But in general, it's just a discussion about some of the issues that are taking place. And one of the big issues right now, economically, are some of the tax issues that are on the table, and what makes that really kind of unusual is that the discussion now on taxes are talking about making them retroactive. Now, the courts, including the Supreme Court, has typically not, not allowed. Congress has not passed tax laws that were retroactive unless they were only favorable. For example, when George H.W. Bush and Congress passed a reduction in your withholding. Now, again, that wasn't even a tax change. All that did was reduce the amount of money you had to send in early. When that bill was passed, they made it retroactive to January 1, so that it would, you'd basically not have to send as much money in that year to the government. Of course, as many of you know that lived through that, then when everybody filed their tax returns, they hadn't withheld enough money because they weren't required to, and so therefore everybody owed money that year. And people couldn't understand how, if supposedly you had your taxes cut, which you didn't, but supposedly if you had your taxes cut, how come everybody owed money at the end of the year? Well, it wasn't a tax cut. It was strictly a change in the payment method. And so what happened is that, previously you had to pay in 100% of your estimated income for the year. You had to pay that in 4 equal installments. Well, nobody knows what that number is, right? Nobody knows what you're making this year until you finish the year and you figure out what you've made. Some people have capital gains that occur right at the end of the year. Some have capital losses that occur at the end of the year, and they offset those gains. So it's very hard. If you could predict your income for the year, and in many cases you could make millions and millions and millions of dollars because you'd know the future, and we don't. So what's happened is the government wants to get paid in advance. That's really what it boils down to, because there's a lot of money in cash flow. And so for the government, the more money they get up front, the less money they have to borrow, because they're spending your money when it's coming in. They're not spending your money when they find out how much you actually owe. That's just when we all settle up. But you send your money in on estimated payments, the government is using that money to reduce the amount of money they have to borrow to pay for the budget, to pay for other things. So from a practical standpoint, you've got they care about cash flow, and that cash flow makes a big difference in terms of how much they they have to borrow, and the cost of their borrowing and the cost of the budget. So that's that's what we're talking about: cash flow versus actual tax reduction. That was a cash flow change, and not a not a tax reduction. But what I was getting at on this whole thing with taxes is that they don't typically make tax laws retroactive. And if you think about how unfair that would be, so let's say that you are selling your business, and you don't care what you get. I mean, and you shouldn't care what you get gross. You'd say, well, why? I care if I want $2 million. And I hear business owners say this from time to time. I want $2 million, or whatever the number is. And I'll say to them, so if you get $2 million and you take home $500,000, you're okay with that after taxes? Well, no. I want to take home $2 million. Okay. Well, that's a different calculation. That's a different process. And that's what you should look at, because when you sell an asset, whether it's a stock or bond, whether it's your house or whether it's your business, it's what you keep after taxes. It's your net take home that makes a difference. It's like at your job. If you make $100,000 a year at your job, but the government takes away $80,000 a year in taxes, do you really? I mean, are you going to continue to work for $20,000 a year? Doesn't it make a difference how much money you're taking home? So if I'm taking home less because of taxes, then I'm really not getting the value that I should be getting or think that I should be getting for what I'm doing. And if those taxes go up, it's a cut and pay for me. It doesn't make any difference that my employer didn't cut my pay. If my tax bracket goes up by 20%, I've taken a 20% cut and pay. Now, the other thing that's important there is, do I even get that? Do I even get that cash? So let's say I work at a job and I make $100,000, and they take out let's say $40,000 in taxes, and I take home $60,000, and that $60,000 is cash. They actually paid me every week or every month. They paid me that number, and I actually took home $60,000 in cash, right? So now I've got 60 grand that I actually have in cash. When I do my taxes, I'm going to figure my taxes, and if they took out too much or took out too little, they're going to owe me money, or I'm going to owe them money. But they've given me the cash to pay that because they've withheld the taxes or they've paid me the money. So I've actually got the cash. That's the way it works for most people who are employed in a salary job or some sort of a wage type position. But what about small business? If I'm in a small business and I make $100,000 and that's my net income. Let's say I make $100,000 worth of net income, and I'm going to pay tax on that $100,000. Most small businesses pay tax on the income of the business. The business doesn't pay the tax, so I'm going to pay tax on that $100,000. So, and that tax is going to be $40,000 based on the calculation we're using. But see, the thing is, I didn't take any cash out of the business. There might not be any cash in the business. I may have made that money, but it may be owed to me still. Somebody may have to pay me. Maybe I have what's called a receivable. So they still owe me the money. They owe me the cash. Now I've made the money. Technically, I sold the product to the person. They paid the price. They just owe me the money. So I haven't received the cash yet, but I have the income. So for tax purposes, got to pay the income. I got to pay the tax. I don't have any cash. How do I pay the tax when I don't have any cash? So is it fair then to tax me on that? Well, for small businesses, because that isn't really fair, because the business owner's not going to have any cash to pay you, they allow you to use cash basis. And so for a cash basis tax, then those receivables wouldn't count. I wouldn't include those receivables. But here's the thing, even on a cash basis business, if it's an ongoing business, one that's continuing to operate, I'm going to have to, if it's one that's going to continue to operate, I'm going to have to put some of that, I'm going to have to leave those profits back in my business. So I have to, because I have to pay employees to make the next product. I have to pay for the next inventory item. I have to buy supplies so that I have supplies for the next job. All of those things I have to spend. So just because I made $100,000 doesn't mean I have $100,000 in cash, because I might have $100,000 in cash if I liquidated the business. So let's say this is my last year and I don't have to worry about building new widgets and buying more supplies, and I've laid off all my employees because we've stopped. All right, well then that cash is going to be my income, because at that point I don't have to take any of my cash and put it into anything else. So I would have cash to pay taxes at that point if I'm shutting my business down, or if my business is going down in activity. Let's say, for example, that this year I did $100,000 in net income, but the next year the business is, nobody's buying anything, nobody's selling anything, and my sales go down by $300,000, and my net income goes to almost nothing. Well, from that standpoint, I'm probably going to have cash flow at that point, though. Even though I don't have any income, I might have cash flow because I've collected the income that I would have spent. I've collected the cash that I would have spent on supplies and payroll and all of that. I didn't have to spend it. It might have been cash it was cash from income that was from a previous year, maybe, that I've already paid tax on, but I'm still going to get that cash. So that's a hard concept. And I know it's a little confusing, but it's a hard concept, but it's an important concept to understand, because the government is now looking at things that have historically been considered unfair. And I read an article the other day, yesterday actually, from that a friend client of mine sent me, and it was from something called I think it was called well, it looked like propaganda, but it was basically, which it was, by the way, but it was, I think it was called Proganda, Pro something or whatever, but it was about how the wealthy don't pay their fair share of taxes. And it was interesting. We've heard that comment continually, but what was interesting was how they were calculating the wealthy's fair share. And what they were doing was, in effect, arguing for a wealth tax. So what is a wealth tax? What are they getting at, and how are they calculating? So what they were doing is this. Let's say that I own $1 billion worth of Apple stock, right? So I have this stock, which today is worth $1 billion. Tomorrow it might be worth 900 million. The next day it might be worth $1.1 billion. It's going to fluctuate, right? But I own it. All right. So technically, I have that day, I have that much wealth. Tomorrow I may have more. Tomorrow I may have less, right? Because the stock goes up and down. Anybody that knows anything about stocks, retirement, if you're in your retirement, you understand that what happens to the stock price every day means nothing. You've only made money or lost money when you sell, right? You have to sell and reinvest that, or sell it and take the cash and take it off the market to say that you've actually made money or lost money. Because today I'm worth $1 billion, and tomorrow, we find out that Apple is owned by China and is no longer allowed to do business anywhere in the world, and boom, it goes to zero, right? So my wealth went to zero. Now, yesterday I was a billionaire. Today I'm a zillionaire. I'm a zero in there. I have no money, right? So, and that's really what happens. So wealth isn't wealth until you can actually convert it to income. I mean, that's just always the way it's worked. So if I'm going to be taxed on that $1 billion of wealth, first of all, it's going to be as of a point in time. So how are you going to determine it? Is it going to be average? Well, is it going to be the average price that I had for the last year? What if I didn't own it all of last year? What if I owned something else? How do you determine that wealth? Well, you'd have to go out and appraise it as of a certain date. How do you determine what the value of a business is if it's not publicly traded on a stock exchange? How much is my CPA firm worth? Especially if I'm not participating in it. How much is it worth? Is it worth anything, or is it worth a lot? Who knows? The point is, the cost of even determining what your wealth is as of any point in time. You'd have to appraise your real estate. You'd have to go back through and appraise your business. You'd have to look at stocks and bond prices, even if you didn't own them. You no longer own them. That wealth you'll be paying tax on. And as most people know, because they've maybe experienced some portion of this, it's kind of unfair to tax you on something that you don't really have, and it's unfair to tax you on something that you're going to have to sell to pay the tax. So let's say that I have $1 billion worth of Apple stock, and it's still worth $1 billion when I have to pay the tax, but I don't have the cash. I can't send the IRS 16 shares of Apple. I can't do that. So how do I pay my taxes? Well, I have to sell it, right? So now I have to actually incur income tax to pay my income tax. I have to actually incur income tax to pay my income tax. That's kind of that has never been, and there's court cases that's not actual income, and that the Constitution doesn't allow you to tax that as income. It's not considered income until you've converted it to income. Now, you'll hear people say that, well, that allows the rich to avoid taxes, that they pay zero taxes. Well, yeah, but they also don't have any cash from that. And then, and people say, well, they borrow against that. Well, that's fine. You borrow against it. I understand at that point you have debt, you borrow money against it, but you still owe that money back. You still have, somebody's going to take all of that collateral and take all of those assets if you don't pay that debt back. So let's say Apple's worth $1 billion today, and I borrow $500 million against it. I've got a lot of cash and I've got a lot of debt. That's a big risk from my standpoint, because tomorrow, if Apple goes to zero or 250 million, I just lost I can't pay my debt back. And I've lost all that income. So I don't have any wealth. So if I paid tax on that, I didn't really make that money because I never sold it. I never converted it to cash. I never actually had any cash. All I had was something that supposedly had value. That could have been artwork. It could have been a house. It could have been a contract I had on something. It could be the appraised value of something based on conversion to business use, or whatever the thing was. There's a lot of things that you could have that have a value that's not income, and you don't have the ability to convert it to income very easily, and it may not convert to the number that you think it's going to convert to. So why are we talking about this? Because this is crazy, right? We've never done this before. Because we're talking about this. That's the problem. The Biden administration, and Congress, particularly the House, which is where tax bills start, are discussing all of these things. and they are discussing in detail the concept of a wealth tax. They are also talking about income tax and basing that income tax on transactions that have not been completed. They're talking about estate taxes and taxing you on estate items that haven't been converted or haven't been sold. So, say for example, I die and I own my CPA firm, right? At my date of death. If somebody was going to take over my CPA firm, say a family member or whatever was going to inherit the CPA firm, typically they would inherit it at whatever the fair market value is. I'd have to have an appraisal done of the business as of the date of my death, and that would be the value of the firm that would be for estate tax purposes. But as long as my estate isn't more than $11 million, I don't have to actually pay any tax. So I don't have to sell my CPA firm to pay the tax. But if now, on the other hand, that the estate tax limit, instead of being $11 million, was 500,000 or zero, all right, then I would have to sell my CPA firm to pay the tax. Well, the question is, how much can I get for that CPA firm? Is that CPA firm worth anything if I'm not there? How much of the value of my CPA firm is based on my reputation, my knowledge, and my experience? So realistically, it may have a value, but can I really sell it for that amount of money, particularly if I'm not alive? So do they value it as if I'm deceased? Well, no. They have to value. Appraisals are based on what's called ongoing value, going concern. In other words, it assumes that the business is going to continue to operate in the manner that it's operated in. Otherwise, you would have to value it on a liquidation value, what the assets are worth. Well, in a CPA firm, there are no real assets. There, you don't have you got a few desks and some telephones, but most of what you have are people and the history of the company and the experience of the owner and all those kind of things. So you don't have that kind of you don't have that kind of hard asset value. So these are all of the problems that we've faced. That's why we've never done a wealth tax. That's why no country has really done a wealth tax. We've had a couple countries tried it and abandoned it almost right away because there was no way to collect it, and there was no way to determine what the values were. You got into huge disputes over what the fair market value of an asset was as of any point in time, and because you can't determine that. If it's one thing if every company is publicly traded, but the bulk of the businesses in the United States are not publicly traded companies. That's only the very, very big ones. So if I own Apple, if I own Google, I know at least what the fair market value as of a particular date is based on the stock price. But even that is not necessarily going to be a solid price. I can go to the stock market and I can see what the price is. And you say, well, that's the price you'd get if you sold it. That's the price I would get if I sold a share or 100 shares. What if I'm selling all of it or control of it? What if I'm selling 51% of Apple? What if you're going to be the guy that's now owning Apple? You're going to own all of it. What am I going to pay you more if I get to own the whole business? If I get to control it? I don't own 100% of it, but am I going to pay you more for control? Yes, absolutely. If my business is worth $1 billion on the open market on a publicly traded stock, but I can get control of that company and do whatever I want with it by only coming up with $500 million, then maybe I would pay 600 million, and a little more than $500 million. I'd pay 600 million because I have control. So I only own 51% maybe, and I'm paying as if I own 60% on the market, but I'm paying a premium for having control of the company. because I don't want to be a passive investor at that point. If I'm going to own that much of the company, I want to say in what the company's going to do. I want to control its board. I want to control its management, and I want to have control of the company at that point. If I can buy that for another premium of say 100 million only, and I can now I can have control of $1 billion company for 600 million. See what I'm saying? If I can do that, I might be able to make my 600 million worth a lot more, because I can control what the company does. I can control what products it goes into. I can control what types of things research it does and what it doesn't do, and what it's involved in and what it's not involved in. So that's that's what we're looking at. Some of the confusion that's happening, because there's a solid block of primarily socialist people in Congress, particularly in the House, that are pushing very, very hard for a wealth tax. They want to strip all wealth away from everyone. They either want to tax it away or they want to take it away at death. So that's their goal, is to kind of, because if people can retain wealth, it allows people to, other than the government, to determine what happens in certain areas. People can decide how they want to spend their money, rather than having the government decide how they should spend their money. In that type of a concept, in a socialistic concept, let's with say Bernie Sanders. I mean, that's not, that's a true statement. He is not a Democrat. He's a Democrat socialist. He's a socialist, and he's independent of the Democratic Party, although he caucuses with the Democratic Party. So the bottom line is he's a socialist. As a socialist, he truly believes that none of that wealth should transfer, that the government should manage that wealth, and that it should not transfer to the next generation. It shouldn't be in the hands of any one party. That wealth belongs to the state, not to the individual, and therefore the state decides how to spend that wealth, not the individual. We kind of had a statement to that effect when President Obama said, "You didn't build that." He basically, most people don't remember what he said after that, and they really should. People got all about, well, I did build that, but his point was that in his thinking, which frankly was socialist, in his thinking, he believes that the government provided all of that, and that the business wouldn't have been successful, the individual entrepreneur wouldn't have been successful, had the government not provided them with a bunch of resources. I mean, you can argue some of that. I tend to think that most of the businesses that I've seen that have been successful, most of the entrepreneurs that I've seen that have been successful, it's never been as a result of the government giving them anything. It's always been as a result of working harder than the next guy, or the next woman, whichever the case may be, and working harder. And a lot of it's luck too. Some of it's just being at the right place in the right time. Doesn't have to be, it doesn't have to be the government. It happens to be, just somebody being diligent, continuing to push at things, continuing to go after things. It's why a lot of people that are millionaires at some point in their life were poor, were broke, filed bankruptcy. A number of wealthy people have filed bankruptcy. Why? They went after something, they took a risk, didn't work out, and they had to make good on that. They had to try to get themselves out of that, start over again, and rebuild. And so many of them have. But the point, though, is that the government right now, there's a large block of members of the House in particular, where tax bills are generated, who believe that there should be a wealth tax. So we're dealing with this wealth tax, and then this at the same time, we're dealing with whether or not this is going to be retroactive. So what I mean by retroactive is that, let's say in September, there's a budget bill passed, and in that budget bill, it changes some of the tax laws and administration within that. Okay, so the budget in there has some language in it that requires certain taxes to pay for some of the budget items, because under that process it's handled under reconciliation rather than handled through the Senate on the normal process, which would require a 60% vote. It only takes 51%. So let's say they get 51% of the House, they get 51% of the Senate, and this thing goes through, right? And becomes law. Well, typically it would become law when the president signed it, which would be sometime in September, right? Or usually it's closer to December by the time all that gets reconciled. So it would go into effect December 1st. So any transaction after December 1st would typically be under the new tax requirements. Anything prior to December 1st would be under the old tax requirements. And that's the way that historically it has always been. It has always been that way. And the reason, of course, for that is, how can you plan? In January, how can you decide what you're going to do if, in effect, everything was sold, or everything is that in December somebody's going to make a law that changes what the law was in January? So let me give you a specific example. Some people out there right now are really, really happy. So I'm going to give you a really good, solid example of what kind of problem you might be looking at as an individual. Because all of this discussion right now, people are saying, well, I don't have a business, this doesn't affect me, and I'm not wealthy, so this doesn't make any difference at all. All right. Okay. So let's say you sold your house and you got a really, really, really high price. All right. And so now you've got this money and you got this really high price. So right now, as long as your gain on the sale of your house was less than $500,000, you don't have to pay tax on that gain. No capital gains tax, no tax, nothing. No tax whatsoever on that transaction. It's called Section 121, and that's an exemption to tax. All right. So now what you were doing is you took that cash and you decided to reinvest that cash. You took your profit, and before maybe you had a mortgage. So now you've taken your profit and you put that profit back in and bought another house, probably a smaller house. You may have paid almost as much as you got for your house, but you bought a smaller house and you own it free and clear. You got rid of your mortgage, right? So you downsize because you're going to retire. So you took, let's say you sold your house and you sold the house for, let's say, $800,000. You had paid $300,000 for it. So you got a $500,000 gain, which you're not going to pay tax on. Let's say that $800,000 that the house that was worth $800,000 that you paid $300,000 for, let's say that you owed still $200,000 on it, right? You owed $200,000 on that house because you had done some remodeling, maybe put in a pool, whatever you had done. And so you borrowed and you owed $200,000 against this $800,000 house. All right. So you paid this house off. You made a $500,000 profit on the house, but you actually got out about $600,000 in cash. So you got $600,000 in cash because you, like I say, you bought because you had a mortgage and on the house. So you only got, instead of getting 800, you only got 600 because you had a $200,000 mortgage. So now I took that $600,000 and that I got out, and I turned around and reinvested in it, and I bought a $600,000 house. But I bought it free and clear. I don't have the mortgage anymore. It's a little smaller because prices have gone up, right? But I'm okay. It's what I wanted. Maybe I moved to Florida, whatever I did. So now I did that 2 months ago. Now at the end of the year, Congress decides that they're going to pass this budget bill and they need revenue. So they decide one of the places to get revenue is to eliminate Section 121 of the code. All right. Well, I wouldn't sell my house at that point. I might hold on to my home. But wait a minute. I already sold my house. Well, we're going to make this retroactive to January 1. So now instead of owing zero taxes on my $500,000 gain, I owe 20%. All right, 20%. So now I own $100,000. Well, wait a minute. I don't have $100,000. I put all $600,000 back in. In fact, I put less than that in because I had some costs. I don't have it. So where am I going to get the $600,000? Where am I going to get the $100,000 to pay the tax? Oh, borrow it? Okay. So now I've got to go borrow money against my house. Interest rates may have gone up. I might not qualify. My income has changed because I'm retired. I can't borrow the money. I can't borrow the money at a reasonable interest rate. How am I going to get the money to pay the $100,000 in tax? Now, let's go further. Congress has decided that if you make over $400,000 a year, that you're wealthy, and therefore you shouldn't get advantage of the capital gains rates. You shouldn't only pay 20%. You should pay 40% because you're over 400,000. You say, well, I'm not over 400. Yes, you are. You had a $500,000 gain. So even if you didn't have any other income in retirement, which you probably had Social Security and other things, which is taxable, by the way. So now you've got this $500,000 gain that you now owe 40%. You owe $200,000 worth of tax. So now you've got to go borrow $200,000. So now you've got to borrow $200,000 against a $600,000 house when you only owed $200,000 on an $800,000 house. You would have never done that. Had you known that was going to happen, you would have never downsized. You would have never made that decision. But at the time that you made the decision, the law was different. But what we're talking about is retroactive. What the president has said is that some of this stuff is going to be retroactive to when we started talking about it. He claims he started talking about it somewhere prior to April 1st. So we're talking about making some of this stuff retroactive to February, to March, even when it wasn't in committee yet. Nancy Pelosi has certainly got the committee, her tax committee, looking at these items because she wants to at least have them in committee. Now, there is no bill that's being proposed in committee yet. Nothing has come out of committee. That's when typically the earliest they will ever do it is when it starts being discussed in committee, because that's public record and people understand that it's being discussed. This has not been out as public record yet. There is nothing proposed because I don't think the committee yet is willing to deal with some of the stuff that they're talking about. But keep in mind, in the House, who's responsible for some of these committees? Nancy Pelosi rewarded some of the people in the House who were the most socialist people. AOC and others are now in charge of some of these committees. There are socialists in charge of some of these committees. They have no problem with proposing what we're talking about. The reason that it's probably not in place yet is because they can't figure out how big they want to make it. There is some discussion right now among the Democrats about, go big or go home. There's a feeling that unless they can accomplish all of this stuff before the next election, that it's never going to happen. So they're trying to get everything that they can get done as quickly as they can. And they haven't been able to get some of this stuff through the bills. So they're going to have to wait until December and do it as part of the budget reconciliation process. So that's kind of what's going on now. One of the things that's interesting about all of this, and I had heard this the other day, and I hadn't really thought about it, but I heard it on one of the talk shows the other day. The why if the president is going to if the president knows that once there's there's a Congress, new Congress, that Congress is going to overturn some of the stuff that the previous Congress did, which is what happened when Trump came into office, and along with him came a lot of a change in the House. So the question became, the question becomes, when that changes, why would you go to this trouble? Because we'll only have to deal with it for 2 years, and then it's gone, and we don't have to deal with it anymore. Well, this person made a good point. Once an item is in the budget, it's in the budget, right? Congress doesn't typically cut the budget. In other words, what he was saying is and I had heard this a number of times before, but just really hadn't dawned on me why it makes sense. But when the Congress talks about cutting the budget, they're talking about cutting the increase in spending, not actually cutting the budget item itself. It's not like state government where they actually are taking an item out of the budget, or taking it out of the budget itself, no longer funding it, right? The Congress in the state of Florida has a zero-based budget. So every year they basically determine what they're actually going to spend money on. The federal government does not have a zero-based budget. All they're dealing with is how much they're going to increase the existing budget. And typically they start with whatever the inflationary adjustment is. They're going to start with an increase of that amount. Then they start paring back that increase. So when you hear them say, we're going to cut military spending, we're going to cut whatever, they're not cutting that out. They're not cutting military spending, the dollar amount. They're cutting the increase in it. They're cutting the increase in other programs. So the point is, if your program is already in there, it may not get an increase, but it also is probably not going to get cut, because the program would have to be removed. And to get removed, it may take too large of a vote to happen. Perfect example of that is the Affordable Care Act. The Affordable Care Act, from the time that Trump was elected and a number of Congress people were elected, they said, we are going to eliminate the Affordable Care Act. They didn't have the votes to do that. So the Affordable Care Act was still in the budget. Now they stopped enforcement on stuff. They stopped, they cut penalties on items so that they actually reduced those penalties, but they did not eliminate the item. The budget item itself was not eliminated. They just eliminated the percentage of funding of increase in funding for that year. So in reality, that's why there's a push right now for this stuff to get done. That's why the president is currently posturing about making this stuff retroactive, because he wants to get it in so that it's in the budget for the year, and it can be so that he can raise some of that revenue in advance of some of the stuff that's going, so that when the budget comes up, there will be cash, there'll be income and cash to pay for that. And so that means a retroactive tax increase. Now, the thing that's going to make this more complicated is we're not going to know all of this until long afterwards, because what's going to happen? Well, the first thing that's going to happen is there's going to be a challenge to this, and it's going to be challenged, and it's going to go to the Supreme Court. Now, the question is, they may be able to challenge the constitutionality of what's in the budget. But again, if Congress doesn't actually pass an act, but rather operates through administrative fiat, and keep in mind, the IRS has a tremendous amount of authority and power on how they interpret the regulations and interpret the statutes. So the statute may say one thing, but what the IRS says that the statute says is how it's enforced. Those are called revenue rulings and revenue procedures. And they have the authority of law. They have the authority of Congress, basically. Doesn't mean they're constitutional. Doesn't mean that they're correct. You can still challenge them. They can still be overturned. But if you don't follow what they say, you have to tell them you have to tell the IRS you're not following what they're saying. So you open yourself up to an audit and a challenge automatically. So this is one of those kind of things where once the IRS says something is going to be a certain way, if you don't follow it, you're pretty much better be planning to go to court. And in this case, you might be planning on going to the United States Supreme Court, which could cost you a lot of money. So it's going to take a while for one of these cases potentially to filter into the system. And by then, who knows what's going to happen. And the economy keeps going. You may not have any money. If the economy collapses, hyperinflation, you may have way more income than you thought. So we're looking at a very, very difficult period of time planning wise. My feeling is I don't believe that they will successfully make this stuff retroactive. I don't think that they will pass the wealth tax. There's too many Democrats who are opposed to it. Virtually all the Republicans will be opposed to it. So I don't see us passing a wealth tax. It's a hard tax to administer. Now, a national sales tax, a VAT tax, that's a different story. That tax isn't as hard to administer. We could look at something like that. But I think I don't think we're looking at a wealth tax. I don't think we're looking at retroactive, but we could realistically be looking at capital gains at a fairly low rate going from 20 to 40. Whether they'll get rid of Section 121 on your house, I don't know. That would affect a lot of people. But that's what we're talking about. So keep your eye on Congress, particularly the House. Watch for what's happening. I'll try to keep you informed on this show, and we'll talk about it as things are happening. But thanks for joining us here on Treasure Coast Solutions. We're here every Wednesday on WSTU Digital 1450, Martin County's Heritage Station.